I have not sold a stock in years, and that's why my net worth keeps exploding. And the reason yours isn't exploding is because you're constantly selling, trying to take a profit. So, just a quick dive in would be there's a bunch of reasons. This is directly from my ebook, Money Isn't Real, but there's a bunch of reasons why you don't want to sell. One would be that you trigger capital gains. And you might, if you've owned it less than a year, you are going to pay anywhere from maybe 10%, depending on your income. I would say most people will pay much more than that, up to around 37%. And this was based off of when I wrote this, which was in 2024. If you hold the asset for more than a year, you could, based on your income, pay as little as 0% up to 20%. And again, it depends on your income. But here's the thing, you don't pay taxes on debt. So the playbook that I created and am following is grow, 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 never sell, and then borrow back at really low interest rates. So I'm recording this on 10/30/25, and the Fed just cut rates yesterday. So this is about to drop by 0.25%. So it's about to go down even more. So imagine if I were to sell, I personally would have to pay 20% in capital gains. However, if I don't sell, I do get to continue with the stock growth. I get to keep the asset, so the asset gets to grow forever, and I get to use the same money at 5.25%. So most people, they think they need to sell to do things. If I wanted to get a new vehicle, I could say, let's say it's $20,000. I guess for a lot of people that might be like a pretty nice vehicle, right? That would cost me $90 a month. In some of my other videos, I do talk about some loans and the power of interest only loans. Imagine if you go to the bank and get this same loan, that might cost you $350 a month or $300 a month. And it's going to be a principal and interest loan. I also dive into that in my book, Money Isn't Real, but that's not really the subject of what we're talking about today. So I won't go too deep into that. Let's give you another example. Let's say you needed $30,000. Look, it's only $135 a month. Just to give you an idea, each $10,000 is going to be $45 a month at my current interest rate. So that money can hit my bank account within 1 to 2 days. Usually it's one day. And that is how I essentially, I don't, a lot of people they say they live out of their brokerage, right? So I sort of do that. It's just that I manually do it. I don't have the paycheck go in and have rules where things automatically move. I might do that in the future, but I do like to manually move my money around a little bit. And I do, a lot of people auto pay everything. I like to manually pay some bills. I know that's kind of a waste of time, but I like to see where my money's going so I know I'm not accidentally paying for a subscription I didn't know I had or things of that nature. But it has been a very powerful year. So if I were to have sold at some point this year, I wouldn't be up 34% on such a, for me, a large number, 597,000. So the goal is to have consistency, to never sell, to never have losses. So here's a couple quick tips on how you can do that. Would be I don't day trade. Here's things I don't do. If you want to do them, by all means, do whatever you want. So I don't day trade. I don't do options. I don't do calls and puts. I don't buy any crypto. In the future, I might buy Bitcoin, but I would never do it with leverage. And the reason I don't do any of these things is I'm not chasing quick returns. I'm not trying to get these huge gains. I do get great gains, but I do it with consistency. And the goal is to get a large amount at as early of an age as possible. And let me show you why that's so important. So the only thing I like about Dave Ramsey is his investment calculator. So when I go here, let's say you're 20 years old. And by the way, I'm 33, so I'll run it with my example in a minute here. Let's say that you let's say that you do this until you're like 45 years old, right? So let's say you don't have any money right now, and let's say you can do $500 a month, which hopefully some of you can do that. Let's say you earn a 12% return, which is not crazy by any means. My last 4 years, I've got like a 30% return. I don't think that's going to happen forever, so don't come after me and try to put me on a cross or anything like that. You would have $1 million if you were to just start at 20, invest $500 a month until you're 45. That's the power of never selling. Let's say you miss 5 years. and don't start until you're 25. That gets cut in half. That is the power of time, right? So we could go back and we could like extend this by an extra 5 years, and you're going to see that it's going to essentially double. Not quite, but 1.7 mil. That's pretty good, right? So I have fiddled with this many times. Let's use some real numbers. So I'm 33 years old, right? Let's say that I do this till I'm 42. I have, what is it, like 596,000 or something now. And then, by the way, I have a 401k. I have like money separate. I do have some rentals. Let's say I don't invest any more money. So before I ran numbers with 14% return and someone came after me, I'm going to do it again. Okay. I would have 2 mil if I don't even invest another dollar. But if I'm going to keep investing, so that's the thing. And let's say I get a 12% return. Let's say I get a 10% return too in a minute. So I would still have 1.7 mil if I didn't even add another dollar. Let's go down to 10%. I still have 1.4 mil. Let's extend my time horizon because time is so powerful. Let's say I do this till let's go to 48. At 10% return, I haven't even added another dollar. 2.6 mil. Go back to my 14%. 4.8 mil. Again, I haven't added another dollar. Many times I have played with this number, and let's say I add $500 a month. Doesn't make that much of a difference because, like I said before, you need a lot early. That's the point of the strategy that I use. That's why, to give you a quick summary of the strategy, and this is just a very quick overview, like the whole strategy is broken down in my ebook as well as in some of my other videos. I go over quite a bit more detail than I'm about to. But essentially what you do, let's just go to like VOO so you can visually chart this here. What you need to do is, if you haven't started, you need to build a foundation, right? So if I were to start here, that would be awesome. Some people, they just want to sit on cash and wait for a dip, but I wouldn't recommend just waiting for a dip. You have to get started, because what if you started back here and you were waiting for a dip? Well, you just missed like 10 years of gains. So rest in peace, right? Instead, what would be better would be to start buying wherever you are, even if it's at the top like we are right now. Who's to say it doesn't go up for 10 more years? Probably it won't, but you don't know when it's going to go down. So you need to build a foundation first. So you just start dollar cost averaging until you have a powerful foundation and until the stock goes down enough to where you can buy a lot at once with leverage. And that is the power of leverage. Is, imagine this. So this dip right here, it only lasted for from February until June. So February, March, April, May, June, 5 months. Whatever you are putting in every month, let's say it is $500 a month, you would have only bought $2,500 worth of stocks. I don't just dollar cost average my money in every month. What I do is I will wait for the price to go down to a lucrative price, and I'll sort of dollar cost average, but I'll do it with debt and I'll do it with much larger numbers. So I will show you exactly what that looked like. Let's go to activity, and you can see that I had some pretty big purchases, and it was because we're going to look at this and then we'll go to the borrow tab. So back in March, let's see, I even did it in February. So in February, I started to buy. It was like little buys, 1,000, 1,000, 5,000, 4,000. And then as the price went down more, 10,000. As the price went down more, 3,000, 3,000. I learned my lesson the first time in 2022 when I used all my debt all at once and I couldn't keep buying. So I didn't do that this time. And I got closer and closer to the bottom. It's 5,000, 16,000 as the price got more and more lucrative. 15,000, 10,000. Like, I bought $100,000 worth in just a few months. Let's go to the borrow tab. So let's go back to that timeline and give you kind of a feel for what this looks like. So I was repaying, like while the market's coming up, I'm paying down my debt. I'm getting ready for the next opportunity, and I'm putting myself in a position of safety so I don't get margin called. Because if you do get margin called, you're going to lose everything. So you need to have safety measures in place. I do go over some in my ebook. I've gone over some in my videos, but you need to have a plan for not getting emergency called. You need to have a blueprint and you need to follow it. It's easier said than done to follow a strategy. It's easy to panic when the market's down 30%. So then what I was doing is, let's see. So green is when I borrow. So I started to buy some. I wasn't really buying much yet, but then it's like 5,000. Oh, my bad. 1 second. Stupid Copilot. So then it was like 5,000, 4,000, 2,000, 3,000, just in short periods of time, right? Like, look at how many days are between these. I bought twice this day because I was like, well, that's a pretty good price. Happy about that. 10,000. This is like a month later. Then it was like 3,000, 3,000, 5,000. Like, these are days apart. And 15,000, 10,000. And then it's like 4,000, 7,000. At some point, I had to buy my truck. So you see, like 37,000. That's because I had to go buy a truck because my car stopped working, but paid off the truck in full in cash with my margin rather than using a bank loan. Sort of like I had showed you how low the payment is at the beginning of the video and how powerful that is. Imagine that you have an extra 400, 500 bucks a month in your pocket. It's so much easier to pay off a vehicle quickly because you have all that extra cash flow that you can just like dump towards that if that's your goal. Typically, it's better to reinvest if you can and if you're in a position to do so because your ROI is much higher. So what I mean by that is, side tangent real quick, is if your interest rate is 7% and you pay down in debt that costs 7%, you're giving yourself a 7% return on your money. If you know that you can earn a 12% return, you're giving yourself a 12% return by investing it instead. So it's so important to understand that there's a spread with money. So many people, they have the Dave Ramsey mindset where they need to pay down debt, pay down debt, pay down debt. But when you understand that you can borrow money at 5% and earn money at 12, 15%, it's a no-brainer to do that. But you have to know how to do that the right way, and you have to have safety measures in place so you don't lose all your money. And at first, it's easy to take risks, right? So what I mean is when you're starting out, you can use like a lot of margin relative to how much you have. And it's not very scary because it's really easy to pay back $5,000 compared to $200,000 or $700,000, right? It's like a lot harder to pay back these large numbers quickly, which is why as you do this longer, it becomes more and more important to hedge your risk and to just be more aware of protecting what you have already built than trying to grow even faster. So I'm not there yet, but I'm starting to see how important that is. So 67% margin health, and we are in the process of getting this up to 70 to 80%. And then if the market is continuing to go up, I might continue to just buy shares or I might continue to get a little closer to 100%. So I'm in just a very powerful position next time there is a downturn. So make sure to like, comment, and subscribe. Helps get us out into the algorithm so everybody else is able to benefit from this. So see you next time. Appreciate the support.